Hello, I'm Ryan Hanna, Chief Investment Officer at Cambridge Trust, a division of Eastern Bank. I want to take a few minutes to share our current thinking on the markets, the economy, and the geopolitical developments we're seeing, particularly the conflict with Iran, and, more importantly, how investors can navigate periods of heightened volatility and uncertainty. Market volatility has picked up, policy uncertainty is elevated, and geopolitical risks have moved back to the forefront. That combination can feel uncomfortable, but it's important to remember uncertainty is a normal feature of investing, and history suggests that disciplined investors who stay focused on fundamentals and process are often best positioned when uncertainty eventually fades. Coming into this period, the economy and markets were on relatively solid footing. Growth had been resilient, inflation was moderating, and labor markets, while cooling, remained stable. Across equity markets, leadership had begun to broaden beyond a narrow group of megacap stocks. What's particularly noteworthy is the emergence of early green shoots in the manufacturing sector. After an extended period of pressure, certain indicators suggest stabilization and tentative improvement. Manufacturing cycles tend to matter disproportionately for capital spending, employment, and regional economic momentum, so even early signs of improvement are worth monitoring. That backdrop matters. It provides a buffer against external shocks. Geopolitical events in the Middle East have added uncertainty, primarily through energy markets. Rising oil prices increase near-term inflation pressure and can weigh on growth expectations if sustained, especially if shipping through key routes like the Strait of Hormuz continues to be disrupted. Importantly, markets are treating this as a near-term risk, not a structural long-term break. Longer-term inflation expectations remain relatively contained, and financial markets are functioning normally. This is a repricing of uncertainty, not a breakdown in fundamentals. Higher energy prices complicate the Federal Reserve's task. As a result, expectations for interest rate cuts have moved further out, and yields across the curve have shifted modestly higher. This has been a parallel shift rather than a sign of financial stress. Credit markets remain orderly, liquidity is intact, and volatility, while elevated, remains within historical norms. Geopolitical events are inherently difficult to forecast, and markets tend to react emotionally in the short term. Historically, however, the pattern is fairly consistent. Initial volatility, followed by stabilization, often before the headlines improve. That doesn't mean risk should be ignored, but argues against making large emotional portfolio decisions based on uncertain outcomes. Our focus is on understanding second-order effects, how energy prices influence inflation, how policy responds, and how financial conditions evolve over time. Against this backdrop, our investment approach is grounded in several key strategies. First, diversification becomes more valuable, not less, during uncertainty. Broad exposure across asset classes, sectors, and styles helps reduce reliance on any single economic or geopolitical outcome, especially as market leadership rotates. Second, we emphasize quality and fundamentals. We favor companies with strong balance sheets, durable cash flows, and pricing power. These characteristics tend to matter most when inflation pressures and growth paths become less predictable. Third, risk management and liquidity are critical. This means appropriate position sizing, maintaining liquidity for near-term needs, and avoiding emotional decisions during periods of market stress. Protecting flexibility is just as important as pursuing returns in environments like this. Finally, volatility can create opportunity. When markets move faster than fundamentals, we look to rebalance portfolios thoughtfully and selectively. Historically, these moments often reward patience and discipline rather than reaction. Taken together, we see a market and economy that are evolving, not unraveling. Uncertainty is elevated, geopolitics are influencing short-term dynamics, and policy remains fluid. But long-term fundamentals, diversification, and discipline matter most. These periods can feel uncomfortable, but they tend to be temporary. History rewards patience, perspective, and process. If you'd like to revisit your plan or discuss how these developments affect your portfolio, we're here to help you navigate what's next. Discover more insights at cambridgetrust.com.